In this week's update, markets set for a strong quarter. How can we make it even better? The dilemma for gold and gold stocks. Small cap technology stocks absolutely roaring in Australia. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. All right, we'll start with a bit of overall perspective as we do every week. And I think one of the things that's just been so obvious for probably a number of years, but as markets roll on, it just becomes more and more obvious. And that's that fundamental logic doesn't always equal reality. In fact, rarely equals reality when we think it should. If you think about where we're at the moment, there are so many things that could go wrong around the COVID virus, around the US elections, around the trade war, around the debt. There's just so many things that could derail markets, yet they seem to just keep going up and up. And of course, that's because we're in a secular bull market, and that's what happens when you're in that phase of history. But look, history does say that we should follow the signs, despite what we think. And you've heard me say more than once that we should trade what we see and not what we think. And it's never been truer than it is right now. So I'm pretty comfortable that the next 4 months is probably going to be fairly strong in the markets, certainly at the index level. But beyond the index level, I think some sectors are going to do outrageously well. Now, just looking at some of the stats, October, November, December are three of the year's five strongest months. So I'm talking in the US market here. So the other two are April and May. And in October, November, December, those months tend to go higher 70 to 80% of the time. Now that means that between 20 and 30% of the time they don't. So this is not a guarantee. This is just about probabilities, what normally happens at this time of the year. So that's on the S&P. Now, if we turn to the NASDAQ, the seasonality around the NASDAQ for the next quarter is even better than the S&P. And if we look over the last 3 decades, the average annualized returns for October, November, December are around the low 20% area for each of those months. So that's not in total, and that's an annualized figure. But the key is that the rest of the year only produced a 7% annualized return. That's over the last 3 decades. Now, average statistics can hide individual performance, so that doesn't offer us any certainty about what will happen this time. But it just says that the odds are very heavily in favour of the next 4 months being probably pretty strong, all other things being equal. And there are some other things to add to that. Really importantly, the transport sector is breaking out, and that's a sign of a strong economy. And there is a very high positive correlation with the S&P. When the transports are doing well, the S&P is doing well, because it generally means that the economy is rolling along okay. And the other factor too is that bond yields are rising, which means money is starting to come out of the bond market. And let's just take a look at a chart that really underpins that. So this is the US 10-year bond yield. It's over a 5-year period. So you can see the bond yield was up in 2018, was up around the 3% mark. If we pan right back, you can see that back here in 1981, the bond yields were up around about 15%. Let's just narrow in a little bit, and you can just see bond yields starting to rise up. But let's narrow the focus in a little bit, and we come down to 1 year, and again you can see we're still in a big overall base in bond yields, but definitely turning up. And if we come down to the last 3 months, you can see there's definitely bond yields are on the rise. And so that means that money's coming out of the bond market, bonds are being sold, yields are going up, and that money has to go somewhere. It's unlikely to all be going on the sidelines, so some of it is going to be going into the stock market. And that's why the market is still rising. Now let's look at US sector strength. And last week I talked about relative strength. Amongst other things, and as I said, the transports are breaking out. There is a strong correlation there We've also got the Russell 2000 at new highs compared to where they were when the crash started in February and March. We've also got global PMIs, Purchasing Manager Indices. They're expanding as well, so this is a real economic recovery. Clearly, all the data shows that the US consumer is in good shape. Certainly, the consumer discretionary sector is doing extremely well. My read is that the market senses that there's huge stimulus coming no matter who wins, whether the Republicans win or whether the Democrats win. Either party is going to bring in further huge stimulus. And of course, markets like that, because what happens is some of that money goes into asset price acceleration. It doesn't all go into creating inflation, which is what we've been waiting for the last decade. But some of it certainly finds its way into asset increases as well. Now, how prices move always depends on the balance of evidence. So don't seize on one aspect as the likely driver. And I get comments and emails from people that say, oh yeah, but what about this? Therefore, X, Y, Z should happen. Well, if you seize on just one aspect, you're probably going to be wide of the mark. So simply stay open to all the possibilities. It's the only way that you can deal with the sort of market environment that we have at the moment. Okay, let's turn to American stocks. The S&P rose nearly 4% for the week, back to 3477. The all-time highs are just over 3,500. So it's been an amazing period of strength. Unquestionably, the hottest sector at the moment is renewable energy in the last few months. It's going absolute gangbusters, but it's got plenty of mates. There are numerous other sectors that are moving very, very strongly. Breakouts are working really well in the States. Stocks that are breaking out are going on with it. There's not too many breakouts that are failing. And we're also seeing that buying dips in strong uptrends is also working very well. So there's lots of very good things happening in the US. Now, the US dollar did come off a bit towards the end of the week and was down to 93.06. And the 10-year yield, if you recall back a few months, it was trading down in the mid-60s, the 0.6% area. Now we're heading up towards 0.8, so yield's definitely on the rise. All right, let's jump in and look at some charts. So here's the big picture. This is the monthly chart going back to, right over here on the left-hand side is 1997. So from 2000 to 2013, secular bear market. Within it, a couple of cyclical bear markets and a couple of cyclical bull markets. From 2013 to the current day, we're in a secular bull market, and that secular bull market, if you look at history, could possibly run for another 10 years or longer. Now, within that, we've already had a couple of sharp bear markets. One in 2018 that lasted 3 months, and we had one obviously this year that lasted a little more than a month. But the market continues to roll on, and that's really the big picture that you need to be aware of, and that in secular bull markets, we tend to recover fairly quickly from any bouts of selling, and the market keeps rising. Zeroing in on the daily chart for the S&P, you can see we dipped below key support, which was the peak in February before the crash. We dipped below that for a couple of weeks, but now we're back above that support and resistance line, and and looking very strong. And if you start to break that down into some of the component sectors, so technology, so important to the leadership of the market. Technology had a little bit of a wobble, but it was only a little bit technical, really. We had an ABC pattern play out, came back to the peak in July, and now we've come back and we've formed new short-term highs in the technology sector. Now, I did mention that renewable energy was probably the hottest sector at the moment. So this is the index that covers the renewable energy sector. The bottom of the crash, it was down around the 64 mark. Now we're trading at 100, almost 180. So this sector has nearly trebled in the last 6-7 months. and you can see it's certainly volatile. We got sold off when we had some selling in September, but look how much it's rebounded since that bit of brief selling in September. Now, the other sector I mentioned, of course, was transports. So there's the transportation index. If we take a big picture look, so these were the all-time highs. And if we zero in a little bit more, you can see just how strongly the transportation index has rebounded since the lows in March. And now we're just breaking out, just basically on Friday, breaking out to new all-time highs. And that's a very, very positive signal. And as I said earlier, the correlation with the S&P between the direction of the transports and the direction of the S&P is an extremely strong correlation. Now, looking at currencies, there's the US dollar. So we had a rise for a week or 10 days, but now we're coming off again, and you can see quite a sharp move down in the US dollar on Friday, and that certainly helped gold to rebound back into its range. Again, something a little unexpected, but you've got to remain open to the possibilities. If we look at the Australian dollar, of course, it's just the mirror reverse of that, and we had quite a strong session on Friday evening and closed at just over 72 cents. So that's the American market. Turning now to the Aussie market, was our dollar finish, so it's pretty much in line with what the US dollar is doing, and also helped by the strength in iron ore, which, thank goodness is keeping us afloat at the moment. We'd be in a lot of trouble without that iron ore strength. Now, the ASX 200 gained 5.4% on the week. It was a big week, and you can expect to see probably more strength on Monday. We're seeing strength across all sectors through the week. All sectors did well, but especially small caps in Australia. If you look at XSO, which is the index that covers the small caps, so that's a very broad brush, but it's on the rise. They're doing well. And there are so many great technologies being developed in Australia. I just wish we could exploit them further here in terms of creating more jobs, creating more manufacturing. But the amount of fabulous technology being developed in this country is really quite awesome. All right, let's just have a quick look at the Australian indexes. So there's the ASX 200. So quite a strong week, and I wouldn't be at all surprised to see a breakout occur in the next week, such as the strength of what's going on overseas. So we just need a little bit more. So that breakout level is around just under 6,200 points. Now, turning to precious metals, gold rose $30 and it finished at 1931. Now, the key line in the sand, support and resistance for gold, is at 1915. So we're back up into the range, and I wasn't expecting that to happen quite so soon because October is weak. We've still got another 3 weeks to run, and look, a lot of it is because of just the strength in US dollar. It's a currency effect. There are other factors that play on it, and if the US dollar were to strengthen, then of course gold could come back. But the overall trend, the bigger picture trend in the US dollar is down. So, who knows? Maybe that's it for gold. Maybe we've seen the lows in the gold price. My only dilemma is that it just doesn't fit with the seasonality, but on the basis of you've got to trade what you see and not what you think, then we can't ignore. And I've got a suggestion for the way to play the sector in just a minute. But if we look at precious metal stocks, there really is a dilemma there, because precious metal stocks, if you look at the top 20 or 30 global stocks, they're at very low valuations in terms of PE ratios and all the other financial metrics, but they're still overbought. The excess that we saw when the gold stocks had a run up through the middle of the year, they're still a bit too overbought. Normally you see gold stocks pulling back a larger percentage. You often see them pull back. You see GDX pull back to the 200-day moving average. We haven't got there yet. So the excess hasn't been washed out, and that makes me a little bit cautious. So we've got very attractive valuations, very low valuations, almost historic low valuations, but we still need a bit more of a short-term washout for me to feel comfortable. So hence the dilemma. So a further 20% down in GDX would be normal. Now, I guess these days anything's, we're far from normal on anything these days, but we'll just have to wait and see. Now, I think what we're also going to see is that profits are set to explode in the third quarter. Now, the reporting season for gold stocks in the States starts pretty soon. We know that the all-in sustaining costs went up in the second quarter because a lot of gold mines overseas were shut down. They didn't shut down in Australia, but overseas a lot of production was shut down, which meant that the costs went up. That means margins went down and stock prices didn't do very much. But with mines returning to production, the all-in sustaining costs are going to come down. The gold price is going to go up, or has gone up. The margins are going to widen significantly. The profits are going to explode, and people are going to look at these valuations and say that's just ridiculous. So I think we're poised for a very good period in gold and silver stocks. We just need to get through these next few weeks of seasonal weakness. So my guidance would be, as a suggestion to consider, that you start to nibble away a little bit, but certainly I wouldn't be going too heavy at the moment on gold stocks. So the top 25 gold stocks, their PE ratios should decline to around about 10 or even below when we start to see the third quarter earnings come through. And if you compare that to the expected year-on-year profit growth, which again, I'm just talking the major stocks here, the expectation is that we're going to see 50 to 80% year-on-year profit growth, and they're trading on P's of 10. I mean, come on, that's just way too low. So I think the sector is extremely well positioned for the longer term. So let's start first of all with the gold chart, the gold price on a weekly chart. So this was the trend channel that started in 2018. Had a very strong run up, but then we managed to get even stronger and break out of that trend channel. Now, there was a key support and resistance level, which was basically the 2011 all-time highs, or previous all-time highs. We broke down below that. That was a very important breakdown. And I would have expected that we would continue further down, perhaps to this level here, around about the 1790 area, or possibly even to the bottom of the trend channel. But as you can see, we've bounced back into the range on US dollar strength. Now, if we look at that on a daily chart, you can see the 200-day moving average, again, down around about the 1790 area, which fits with this key support level as well. So it's just hasn't washed out enough, and we'd rallied back to test that breakdown level. That's all perfectly normal. So it was all lining up really, really nicely until Wednesday, and then we failed to get further downside towards the 200-day moving average. So that's that's the dilemma for the next few weeks. But there's little question in my mind that this is set up very, very positively for the medium to longer term. And similarly, silver, we saw a really nice move in silver, which had been quite weak and lost some ground relative to gold. But a really powerful night for silver, and that's a pretty good sign. Now, if we look at some of the spread ratios that I've been showing, this is silver versus gold, so that ratio got really extreme in the March crash. We then came down really, really strongly as silver outperformed gold, did the catch up. Long term, we really should see this level down around 50 times, something of that area. So we're still quite elevated. As you can see over the last few weeks, this line rising means silver is underperforming gold, but that partially reversed itself on Friday night. And if we look at, this is GDX versus the gold price. Again, historically, we're looking for somewhere in the mid 0.45 area. We're still down around 0.23. So that means that for the current gold price, so without the gold price moving, on a normal valuation ratio, we really should see GDX double from here without the gold price moving to get back to a position of normality. But look, they're all long-term averages and they may take years and years to adjust. So you wouldn't want to invest or trade purely on that basis. But it certainly tells you that we've got plenty of potential upside in the gold sector. So if you look at GDX, you can see we've pulled back to what was obviously a pretty obvious sort of support level. We had a little bit of a bounce, so I was all good with that, but I still expected a move back towards the 200-day moving average, which would be down around about 34. GDX closed at nearly 41 with a really strong bounce, as you can see on Friday night. So that's the precious metals sector. And I've been showing these holdings. So this is millions of ounces in GLDs. This is the amount of gold that's being bought by investors. And you can see we stalled throughout August and September. But so far in October, and we're only a small way into October, you can see that it would appear that the investment buying into GLD has returned, because we're now basically almost up to the highs we set back in 2011. Turning to other commodities, copper firm, that's really just on currency to just over $3. Crude oil jumped up to 40.5, but that's really about there's a hurricane threat in the Gulf of Mexico, so that was related to that factor. There's the spot copper chart, and I thought I'd just check on nickel as well. So base metals looking good, and base metals from a fundamental point of view for the next 5 years should do pretty well. So wrapping it up, when it comes to precious metals, short term is risky, but I think you can start to maybe, unless you've already got quite a lot of exposure to precious metals, I think you can start to edge it up again, but just be careful in the short term. But long term, it looks highly bullish for precious metals. Now, just to recap on last week, because I think it really is a very important message, what is really working extremely well at the moment, has been working well for a long time and will probably work well for a long time in the future, is to construct your portfolio around a combination of using current relative strength, find the strongest stocks in the strongest sectors. So combine that concept of relative strength, what is moving now, with some stocks that have got the probability of, the really high probability of strong future growth that may or may not be moving now. There may be a tremendous story unfolding in areas of really unstoppable trends: 5G, artificial intelligence, medical devices, biochemistry. There's just so many great areas out there that are going to grow, and it's got nothing to do with who sits in the White House, what their policies are, what the trade war's doing with China. It just has nothing to do with that whatsoever. So they're the sort of areas that are the areas you want to be looking at. Portfolio analysts this week, there's just opportunities everywhere. So it's really just a matter of getting organised, getting focused, and picking them off as the opportunities come up. There's more information about what I do on our website, and there's my email address for any non-members that wish to communicate with me. That's it for this week. Cheers.